Hello, traders and investors. I'm Jason from Leavitt Brothers. I want to talk about these ARK funds run by Cathie Wood. She's become a little bit of a market icon, which I don't know if it's a good thing or reminds me of a handful of similar people uh, from the late 90s. ARK is a collection of open-ended ETFs. Think of them as publicly traded hedge funds. They're not investment trusts, which are fixed and don't have inflows and outflows. They don't expand and contract. The ARK ETFs are open-ended, which means they do expand and contract. They are subject to the creation redemption process. When people put money into the ETFs, the stocks that are held by the ETF are bought, and when money is pulled out, the individual stocks are sold. So think of it in the same light as a hedge fund raising money and then needing to put that money to work, or having a big investor pull money out, which forces the fund to sell their holdings. The mechanism that enables this to happen isn't important. It's sufficient to know that as money comes in and ARK's assets under management have increased over 1,000% in the last year, shares of the ETF are actually created out of thin air. The reason why this is important, the reason why you should be aware of it, is because it means momentum in both directions can go to extremes. If ARK buys a stock and publishes that purchase after the close, traders viewing ARK as the experts will jump on board, which pushes the stock up even further. And when traders buy the ETFs, the stocks in the ETFs have to be purchased. It's a positive feedback loop, which can push stocks much higher than they should go. The opposite, of course, is also true when selling takes place. By itself, this isn't an issue. The problem is ARK likes to invest in small, high growth, disruptive companies. We've seen many small cap growth names literally rally 2 or 300% and they get cut in half in just a couple months. Okay, is it possible ETFs such as the ARK funds are contributing to the extreme moves in the market? You have legit companies that are trying their best to compete and grow, and their stocks are doubling and then getting cut in half, even though nothing has changed about the companies. Because the ARK ETFs have gotten so popular, they own over 20% of 5 different companies. Like literally, they own a 20% stake in several companies that are relatively small and not very liquid. And they own more than 10% in 29 companies. I don't think it was their intention to take such a big position in so many companies, but they're forced to because as their assets under management have grown, they've been forced to keep buying these stocks. So here's a potential problem I see. If there are redemptions and ARK must sell some stock, but it's hard to sell the somewhat illiquid small cap names that they have huge positions in, they have no choice. They have to sell the larger, higher volume stocks, and this can lead to a domino effect. So I'm wondering if the ARK ETFs are like little ticking time bombs. If the market moves up, they work great, everyone's fat and happy and making money. But it's much different when they move down, isn't it? They've gotten so big, and because they are actively managed, I wonder if a downtrend which causes traders to sell the stocks and the ETFs, which then forces more stock to be sold, can trigger some sort of run that spirals downward. It makes me wonder if these things really are structured for investment and stability purposes because it doesn't seem like volatility or price movement was considered when they were created. Extreme moves in both directions may be the norm, which is great for trading, but not necessarily great for explaining to the public why some stocks post such massive gains and then collapse. It makes me wonder what could happen if the market built up some downside momentum. The negative feedback loop would not be pretty. I'll see you next time.